Hello, everyone. Today on the final bar, my guest is Tony Dwyer from Canaccord Genuity. It's going to a little more of a fixed income theme to the show today. We're going to have Tony sharing with us some of the macro charts he's paying attention to. We're going to have a segment called Clipping Coupons, where we break down fixed income markets from a more of a pure technical perspective. We'll look at some of the key charts on bond prices, on bond yields, and what sort of patterns we need to know as we try to navigate this bear market rally that seems to be unrelenting, potentially some chinks in the armor today with the sell-off into the close. Ladies and gentlemen, this is the final bar. Good afternoon, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. A rainy Redmond, Washington, a rare treat, a little bit of rain here in the Pacific Northwest. Also some rain if you look at the markets. As I'm preparing for the show, sort of midday, I see the market, continuing to trip higher. I'm starting to question my sanity with sort of the bear market rally thesis, and then the remainder of the day looks like we dropped the ball around lunchtime, and then it sort of bounced along support from yesterday's close to finish right at the lows, sort of settled in right on the ground. And to be honest with you, I think that if there's anything that I've seen that sort of helps validate this thesis of sort of more of a bear market theme, and we're sort of transitioning into another leg down, I think today sort of felt like it, to be honest with you. Continuing yesterday's rally, rotating lower to finish just below the close from yesterday. So we're going to get to all of that momentarily in our market recap, but I did want to highlight some of the guests that are going to be on the show helping us make sense of the world. Coming up next week on Tuesday, we have Craig Johnson from Piper Sandler. On Wednesday, the 29th, we have Todd Sohn from Strategas. And then on the 30th, on Thursday, we have Greg Gumpner from Agora Financial in the Baltimore area. So three great strategists next week to share some of their insights, how they're navigating this environment. Two other things to point out. On Mondays, we have our show Behind the Charts, which is a way to get inside the head of some of the top analysts, strategists, traders, how they use technical analysis, how they got started, and all of that. We had a great pleasure to interview Tony Dwyer, our guest today, on that show, one of our first guests, actually. And Todd Gordon is coming up next Monday. So if you haven't seen that, definitely tune in for that one. And on our YouTube channel, you'll see all the previous episodes and previous wonderful guests. Also on May 13th, our next episode of The Pitch. This is our newest series where we're actually having three strategists on the line with one of our hosts. They each bring five ideas, five trading ideas, five perspectives, and then we discuss it as a group. We did our first run on that a couple weeks ago and went really, really well. And we're super excited to make that a new lineup, or a new addition to the StockCharts TV lineup. Let's get to our market recap. So as I mentioned, and it's funny, I was playing with my 4-year-old a little bit ago before lunch, and just to break things up a little bit. And I thought about, as we were playing with playing with this whole marble run where you drop marbles in and they go through this whole a maze of things that we built together. This market today looks a lot like if you dropped a marble and watched it bounce along the ground. And that's sort of how it felt. It feels relatively heavy. You have stocks that continue to go lower. Each rally today was, less and less able to reach to the previous peak. And, usually a pattern like that tends to resolve lower. If you're looking at the 5-minute chart, that's sort of, it feels like a topping pattern, short-term topping pattern. Again, it's all about the follow through, I think, tomorrow to see how we go. Yesterday, we talked about the rally in stocks and just this continuation of the uptrend. And what I posed on yesterday's show was, do we get the follow through today? And midday, it certainly felt like that's what was happening. But again, I think by the close, it feels like that's sort of taken away. So the S&P finished just below 2,800, around 2,798. So really flat for the day. It was sort of a non-mover. Mid caps and small caps both finished in the green. So mid caps up 1% and small caps up about 125 basis points. The VIX a little lower, around 41 at this point. We're going to talk a little bit about the fixed income markets today. Just want to point out that the TLT bond prices that we usually follow up about 0.5%, the 10-year yield down to about 62 basis points. Commodities, on the other hand, down a little bit. Now, a lot of that is driven by energy prices, to be honest, in terms of how a lot of those are weighted. But precious metals did very well today, with gold up about 1%, silver finishing stronger as well. So gold, in terms of the long-term chart, has held up pretty nicely overall. Looking at a daily chart of the S&P, we'll refresh it here for the closing prices. So what we've seen now is we've talked about, I think I mentioned it yesterday, if the market went up from the lows, which it did, and the last month happens as it does, and I'm trying to draw with a crayon where I would expect a bear market rally to most likely end. It's about in this region between these two orange lines, which is the 50% retracement of this overall trend and the 61.8% retracement of the overall trend. And that puts it between around 2,800, 2,950 would be sort of the back of the envelope area where you probably expect the price to hit resistance. What's interesting is we hit it right at the 50% level. If you go back to the 2018 to 2020 rally, the 50% line is right where we topped out last week. So overall, we've bounced off of that resistance and now, have sort of bounced higher off the 61.8% retracement level. We're back up to the 50-day moving average. And again, today we traded above, but did not close through it. So we haven't had the confirmation of getting the S&P to go above its 50-day and remain there with any sort of staying power. It's serving as continued resistance. So again, you have sort of this confluence of resistance levels that the S&P is up against. And as we talked about before, I think the fact that the RSI has not gotten above 60, that is definitely more characteristic of a bearish overall environment where the market gets very oversold. It doesn't get above 60, and that's sort of the whole range is more depressed than elsewhere. Be interested to hear from Tony Dwyer later just how his macro perspective sort of fits into that bear market rally thesis. Let's break a little bit more into some of the sector and group themes today. So energy, the big winner today, up for over 3%, followed by industrials, followed by materials. So is the MEI trade really leading today? On the downside, you had real estate and utilities finishing materially lower, followed by consumer staples. I think it's worth noting technology was negative, right? So while the S&P finished essentially flat, the XLK was down almost 0.75%, followed by financials there. So a lot of the traditional defensive sectors at the bottom, but also something like technology underperforming on a day like today. So sort of the late cyclical leadership that did okay today overall, relatively more weakness than strength. Interesting to note some of the names that were moving, and the gambling group was the top group out of all the Dow industry groups that we followed. Las Vegas Sands is one of the biggest gainers, the biggest gainer in the S&P, up 12% today. And the biggest improver in our scooter rankings, our StockCharts technical rating, looking for a percentile ranking of all these names. One of the biggest gainers, and that's certainly a change from what we've seen, where the expectations are gambling stocks really struggling through this period. But today certainly a drive higher. The second gainer was recreational products, which is in the same sector in consumer discretionary. But you'll notice some others as well. Recreational services, furnishings, all up over 4%. So there are a bunch of groups within consumer that actually did pretty well. The other big sector represented here on the top 10 industries are energy, and that was clearly the biggest sector gainers. So you had oil equipment and services, renewable energy equipment, which actually has been a pretty compelling chart here. With testing resistance and just closing above it today. So an interesting group to look at if you're not familiar with some of those names, but even E&P stocks, which is a big part of energy, up there in the top 10. I would also point out stocks like Union Pacific. So there's obviously earnings going on right now, and I think UNP was an interesting chart to watch today. And I think this sort of represents how the market feels. You have this gap up the open, breaking to a new swing high, breaking above the peak from the first week in April, but closing back below that peak. So certainly sellers taking control through the course of the day, and not really the follow through after the big gap up out of the open. That's sort of characteristic of some uncertainty for sure. Hess is another one. So you have stocks like this with a doji candle, which is basically when the open and the close are right about at the same level. So Hess is one that has looked kind of constructive, and it's interesting within energy, breaking to a new relative high today because it had a nice move higher, but testing resistance, testing a declining 50-day moving average in the open and close right at the same level. A doji candle, basically visually represents the indecision during the trading day. More often than not, it's a reversal pattern suggesting that you'd see short-term weakness after that. So what really drove the market closer? You get a couple group within materials. You have aluminum, you have coal, which is a smaller group within energy, but then you have insurance brokers within financials. You have restaurants and bars within consumer discretionary, residential REITs, automobiles, which is the big automakers, Tesla and others, asset managers. You have a couple of the interesting parts of the financial sector all on the bottom 10 list today. So quite a bit of movement, actually. This was not a big up day, big down day. By the time we got all said and done, I feel like it was more indecision. There's sort of a give and take between different groups, different sectors finishing across the board. Worth noting, though, I think in any environment, and this is no different, I've always told people, regardless of what the broader market is doing, if there's anything that spending time with Peter Lynch and other stock pickers like him has taught me, is that there are always stocks going up and there are always stocks going down, regardless of the broader market environment. So the great advantage, if you are a stock picker, is there are opportunities. The challenge, of course, is making the right decisions, having a good disciplined process to identify those opportunities and execute on them. That's our market recap for today. We want to take a quick commercial break. We'll be back with my guest, Tony Dwyer from Canaccord Genuity. See you in a minute. Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close to break down the price action from a technical perspective. Try to understand where things are headed and where things have come from. Wanted to remind you, we have a mailbag segment a number of times during the week. You can shoot us any of your questions. The final bar at StockCharts.com is the best way to get your questions in front of us, or look us up on Twitter at FinalBarSCTV. We're getting lots of great questions in both places, and please, we'd love to answer your question later this week. I want to bring on my guest, Tony Dwyer, and despite the fact that before we got started, Tony was making me incredibly jealous, telling me about flying his plane around the Northeast. It's a pleasure to have you on, Tony. Thanks for joining us today.
Thanks, Dave. Thanks.
So
it's been fun.
Absolutely. So, we actually have a bit of a focus on the fixed income markets today, and I'm so thankful that you're on to help us try to make sense of things. There's so much of a focus on the equity markets and on the bear market rally and what's next and how companies are recovering. But what sort of indications, what sort of color are you getting from the yield curve right about now?
So Dave, what's been very interesting about down 34% in a panic move, following a crash like that, there's typically three phases, as you know. You've probably forgot more about this than I know, but there's three phases following a crash. There's the panic phase, where you know that correlations of the individual stocks to the index itself are extraordinarily high. Happened in 1987, believe it or not, 2011. Then you go into the relief rally phase. And the relief rally phase, when the market has been as oversold as it got on the week close on the 14 weeks RSI indicator on the week of March 20th. It's only happened 6 prior times. Your median gain in the relief rally is 17%, but over the last 3 times it's happened, it's been over 20%. So believe it or not, this has been an incredible relief rally. So the question becomes, is it tactical or is it more fundamentally based? Mm-hmm. And I think you've done a good job of answering that by sector performance, but look at the yield curve chart here. What you see is the spread between a 2-year and a 10-year yield curve. The yield curve is something that we popularized and became, on TV a lot, about how it's indicative of a coming recession when it goes below that red horizontal line or the zero line. Why would a bank or a shadow bank lend to lose money. If I'm getting money at 2% and lend it to you at 5%, I'll do it all day long. Not only, though, is it a good indication of a recession, it is also a great indication of an economic recovery about when you're about to come out of a recession. When you look at this chart, you'll see that over the last 3 cycles, the economy didn't really kicked into high gear until this was about 200 basis points. If you go to the next slide, Dave, you can see that historically the S&P 500 does bottom before a recession end, but it also comes with a much steeper yield curve. Following the 1990 recession, it was at, remember, it's at 38 basis points today. It was at 94 basis points, and even in the 02 and 09, it was at 190 basis points. So the thinking here is that if you're about to come out of a recession, the yield curve is so steep that banks are making a ton of money. Like I said, if I got money at 2% and gave it to you at 4%, I'd do it all day long. I'd make 2%. If I got money at 2% and lend it to you at 2.5%, and I wasn't sure if you were going to have a job, I'm going to be a little bit more hesitant. So the steeper the yield curve gets, the more banks are incented to lend despite weaker economic activity. And this is data that shows you typically you come out of a recession, it has to be a much steeper yield curve for banks to want to lend during periods of economic weakness. And if you go to the next slide, Dave, you can see there's been a huge spike in the business loan demand. This is the 26-week rate of change of business loans. And most people would look at this and say, this is great news. Banks are lending. It's horrible news at the end of a cycle. If you see 2008 and 2000, you hit a high because what happens is companies get scared and they draw down their credit lines. So that 26-week rate of change spike was because all the companies were scared that the economy was shutting down. They took down their credit lines so fast because they wanted to have cash available to them. You know you're coming out of a recession when there's a significant trend lower in loan demand because banks haven't wanted to give you the loans. So if you go to the next slide, Dave, and Dave, when you look at the National Financial Condition Indices, this is from the Chicago Fed, and it shows whether there's tightening or loosening financial conditions. The Chicago Fed tracks 105 credit stress indicators that are put out weekly. They're not revised. It's not one of those government statistics that 2 months from now is going to look totally different. And it's a great sense if banks are more willing to lend. So the yield curve tells you that they're not really incented to lend. The bank lending tells you they've already lent more than they want to begin with by companies drawing down their credit lines. And this tells you that they're not close to wanting to lend. So this whole situation of whether it's a tactical relief rally in the 3 phases of a bottoming process, panic, relief, and then frustration. We're in the frustration, and the credit market, in my opinion, is reinforcing that.
These are such a great take, Tony, on the conditions, and I really appreciate it. I'd love to ask you a quick question just on the shape of the yield curve. And for those that are listening that are not as familiar, this is something I've always enjoyed you talking about how this should be part of the process. So, I get the idea that a flatter yield curve or, an inverted yield curve, much less, attraction for a bank lending money, essentially. Is there a certain level? Is it the 200 basis point? Is that the level that we need to be looking for? Or at what point would you be able to put up the green light and say, okay, this is now where we would need to be to feel better about a broader recovery? Is there a certain level or what would you be looking for?
I would suggest it's going to be over 100, but I think it's so important to convey to folks, there's no single indicator that you look at and you say, okay, that's it, let's go. To me, it's this being closer to 100, a decline in the bank lending, as the other chart we showed, which means that everybody's just kind of taking a pause to see what's happening. This one you want to see drop down into the negative territory like it had in 2003 and 2009. And then you want to see the National Financial Condition Subindices trending lower, not spiking higher. Please note on that chart that you have up, Dave, that thing was spiking in early 2008, right? From the current level. So I'm hesitant to say just on this 1 month with the unemployment rate and all the other stuff that everybody knows about, down 34% with historic oversold, I'll take a stab at a relief rally. up 25% from there with these credit indicators, I'd more want to take a wait and see attitude and rather get more offensive on a pullback.
Tony, so much appreciate having you on the show. Thanks again. Please be safe, fly safe, and I look forward to having you again on soon. All right.
Have a great day. Thanks so much, Dave.
That's Tony Dwyer from Canaccord Genuity. And again, we're going to look at the fixed income markets from a technical perspective, but I've always enjoyed talking with Tony for my years on the buy side, because it was always so helpful to see how what we were seeing on the charts relates to some of the financial conditions that Tony was able to illustrate with some pretty well done visualizations. All right, so our next segment is called Clipping Coupons. So building on what we just learned from some of Tony's charts, looking at the yield curve, looking at lending and so forth, is connecting it to a pure technical picture. What are the charts telling us about bond prices, bond yields, and the yield curve and so forth? So when I'm thinking about the fixed income markets, I usually start a couple different places. I actually usually start looking at stocks versus bonds, because it's a great way to illustrate. There are a couple ways you can illustrate sort of the relative bet of looking at one of those markets versus the others. Does it pay you better as an investor to be on the equity side or on the fixed income side? So the ratio of the S&P to the TLT, which is what we're looking at now, when this ratio is going higher, that means stocks are outperforming. When the ratio goes lower, that means bonds are outperforming or stocks are underperforming. So my very subjective, non-scientific way of illustrating that is with the green and red arrows, and that's part of my weekly process, is just adding new arrows when I think the trend has changed. And it's interesting, I have not put an arrow on here pointing back to bonds, but I'm pretty close to feeling that. And the reason why I haven't is because this looks so much like the end of March when you had the big spike on stocks. You had this bit of a pullback in the ratio, and then we sort of went higher. So it looks way too close to that up until now. But I think based on what we're seeing with the potential exhaustion of the bull market or bear market rally, in equities, and with the strength in the TLT that just holds up there, I could see this ratio going lower, going back to favoring bonds over stocks. And overall, again, you can see the general direction for the last year has been down and to the right if you think of the overall direction of where we're at. So let's look back to some specific charts for bonds. So I like to start with the TLT. That's one of the main ways I'll look at bond prices. And again, there are a lot of benchmarks that you can use, but the TLT is pretty liquid. It's very widely used. The TLT and the AG are probably the two most common ones. The LQD would be another one, sort of giving you broad exposure to fixed income markets. The TLT in particular is looking at the treasury bond markets. So what I'm seeing with the TLT is and again, I hate to say to do this, so maybe don't listen to this, but a lot of times when there's a big run, it reminds me when oil had the huge rally and huge sell-off years ago, and then kind of came back to that same trend. If you put your finger over this, the middle of the month of March, you'll see a trend that just sort of continued, and you all of a sudden can write off a bit of this volatility in the TLT as being sort of an adjustment to, the increased volatility across the board, across assets. And then just this uptrend has continued. So, if you consider these huge outliers to the trend and look at the overall regression, look at the channel that you would have created, we're still sort of in the midpoint of this consistent uptrend that started from the end of last year, really beginning of mid-January, when the TLT broke out of this, what you call a descending triangle pattern, this consolidation pattern here from the fourth quarter of last year. And since then, since that volatile period in early March, you've then settled back into this pattern of higher highs and higher lows. And I don't see that ending at the moment. I see that sort of consistently going higher. What's interesting is the RSI has sort of remained, it's not overbought, it's just sort of remaining around the 60 level for about a month now, just showing you this consistent upward move. Now, obviously, this huge spike will affect something like the RSI for a little bit, but overall, it's settling into this fairly consistent uptrend. Now, another thing you could think about is looking at the yield you would get on equities versus bonds, and that's the chart that I show here. It's the yield on the S&P using the dividend. So basically, what's your dividend payment by investing in the S&P 500 in those stocks, and then what's the yield you're receiving by owning a treasury bond, the 10-year treasury bond. And you can see that this difference between the two yields is one of the highest points it's been. It's up in the range of where we were in 2009, has even eclipsed that and gone to 150 basis points. So it shows you, if you're looking for yield, if investors are looking for safety, it still pays to own equities. And this is just the S&P. This is not the higher yielding parts of the equity universe, looking at things like REITs and utilities and things like that. However, there's the safety obviously associated with the fixed income markets and a relatively stable source of yield over time. The last thing we're going to look at is just the 10-year yield itself, and again, this is where I tend to hesitate to draw too many technical distinctions. I don't tend to use the 10-year interest rates and do it from a purely technical perspective. I do use it as a way of illustrating where things are headed, and I think that's what's so beneficial to it. When I'm looking at treasury yields, I remember back here, and I, of course, have drawn the person diving off the cliff. I forgot I had that on there, but as things are rolling over, as interest rates go lower, the question was, well, how can bonds continue to go higher as interest rates are at the lowest point that they've been? And the answer is they can always go way lower. And we saw that with crude oil prices going sub-zero. We're seeing this with interest rates going below zero. We saw the yield curve can become inverted, where short-term yields are higher than long-term yields. So there are plenty of ways that the bond markets can continue in this sort of fashion for a little bit longer and still fit within the range of a normal environment. So my overall quick summary, and we have to cut this a little bit short today, is that I think bond price is still holding up very well until this pattern of higher highs and higher lows in the TLT breaks. I think you have to assume that that trend is going higher. And again, if this is a stock above 2 upward sloping moving averages, I probably feel pretty good owning a stock that looked sort of like that. So that's our segment, clipping coupons, for today. We need to move on to wrap the show with the 3 in 3. So 3 charts in 3 minutes. My producer Gretchen tells me 1 minute, and we're going to get it done. Chart number 1, intermarket analysis. So when we had JC Peretz on the show this week, we were talking about the challenges of where there is this homogenous nature to bonds going higher, gold going higher, stocks going higher. It feels a lot like mid-February, we had that same situation where sort of everything was going up. In that case, crude oil was too, and that's not been the case. I think one of these at least has to disconnect, and based on what we've talked about, I think equities are going to be the one that blinks first, expecting that to go lower. A couple of ways we can think of that. One is with using breadths, and the McClellan oscillator is a common breadth tool, using the advanced decline lines and using some moving averages of those lines. It remains above zero. I think if the McClellan oscillator breaks below zero, that would be sort of a confirmation of a breakdown in stock prices. We have not seen it yet. It's still on the bullish side of the range, but something I'd be looking at. And then the final chart is looking at volume. And I had a question on this via Twitter, actually. I just wanted to point out the fact that, yeah, in this rally in stocks, it's worth noting that the volume has been successively lower. The on-balance volume has held up okay, but in terms of the direction of the daily volume reads, there's less and less volume as this market gets higher and higher, sort of validating that short-term bearish thesis. Ladies and gentlemen, that's our show. I want to thank you for joining us every weekday after the close for the final bar. I want to thank my guest, Tony Dwyer from Canaccord Genuity, joining us outside of New York City with his take on the overall economy. You can send your questions to us at any time, 2 ways. The final bar at StockCharts.com. I'd love to hear from you, answer one of your questions tomorrow on our show. Also on Twitter at FinalBarSCTV. All of our previous episodes on our YouTube channel. Go check it out. For StockCharts.com in Redmond, Washington, I'm Dave Keller saying be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.